Alright, what's up guys, Malik here, welcome back to the channel. I have a video of Celsius coming up, but my editor is taking so long, so I just decided to go ahead and do a simpler video so I could make sure to get something out. So today we're actually going to look at some different kinds of tickers here, like the SQQ, the TQQ, the QID, and to show you what you can do with them, how you can actually make money using these kinds of tickers. Some of these tickers actually track a certain kind of stock or a certain kind of fund, and there's a way to profit from using them. So the SQQ is something that if you go down here, well, if you don't have Robinhood, but you could search it up on Google, and the SQQ provides you inverse exposure to a modified market cap weighted index of the 100 of the largest non-financial firms listed on the Nasdaq. So the SQQ is the opposite of the Nasdaq. So think about it like that. SQQ is the opposite of the QQQ. So if you want to actually find out what's in the QQQ, something as simple as just searching what are the holdings of the QQQ holdings. So the QQQ is like they hold mainly companies of the Nasdaq. So you see their main holdings are like Apple, Microsoft, Amazon, Facebook, Tesla, Nvidia. So if you have a broader market going to the downside, like it's very bearish, the SQQ tends to go up. So that's what was happening last week. You see where the SQQ was in a higher range. So the SQQ was really boiling up last week, and you see it hit 46, it hit 44 last week. So it was really coming up, and that's a way that you could have played it to the upside, the SQQ to the upside, if you knew that the market was going down, or if you wanted to hedge and protect your portfolio. So the SQQ, sorry about that, is a way that you could actually buy into this, or you play options, and that's a way that you could have made money from this. Another one is the TQQ. This one is different. It actually provides you 3 times leverage exposure to the QQQ. So if the QQQ is going up, basically if you have the broader market going up, you have stocks like Apple, Microsoft, Facebook, Tesla, all of those going up. If you were to play the TQQQ, that's how you would get 3 times leverage exposure to the QQQ. So on a day like today, where almost the entire market was going up, if you were to play the TQQQ, you would have made money. So let's even look at some options today. I can look at the price that they opened at and then the price that they closed at. So these are options. If you know options, you see they have a percent change today, 200%. So if you had entered any of these today, you would have made 200% on your money. But if you want to go into more of the data here, you see where if you click it on this platform, Robinhood actually, it would have had a low of the day at 64 cents. So with the option, when it says 64 cents, you're buying 100 of them. So you'd have paid $64 per contract. And then today it hit a high of 240. So you could have made $240 for every $64 that you spent today. So the TQQ gives you exposure to that if you were to hop in and get a lot of that. So you see over the day, it's up just 10% today, the TQQ. But the options is where you get a lot of exposure to the upside. So as you go up on the option chain, you're not going to make money because these are less likely to actually have some value. But when you come closer where you are in the money, you see where you would have made 200%, 185, 162, 147. So this is where you get a little bit more into the options, but I just want to show you some tickers that give you some different kinds of exposure to the market. There's also one that I had played here, the QID, which is the ultra short QQQ. So this is the opposite of the TQQQ. This one gives you, let me show you. Oh, 2 times inverse exposure. So I had played this for the Fed rate hikes. I was expecting the rate hikes to really draw down the market. So let me show you something that I did here. It can be a mistake, or it could have been a good play. Let's see what happened. So I had spent $2,400 here for 20 contracts, right? And then I sold 2 contracts for $340. So what I try to do, I try to make sure that I'm not losing money. I'm trying to make sure that my position is free. It can affect me sometimes negatively, sometimes like I don't ride the whole profit, but I'm making sure that I take no losses, manage the budget. So out of the 20 contracts here, I sold 2, so I have 18 left. So I took 340 off the table. Here I sold 10, so I took 1800 off the table here. As you can see, I sell, buy. These are, when they cancel, is like Robinhood isn't giving me a good fill, so I have to change the price that I want to get sold at to make sure that I get filled at a certain price. So you see I sold 2 here, 10 here, right? Sold 2 more here for 480, and at this point you should see that I got all of my money back. I got 340, I got 1800, I got 480, and then I sold 1 more for $320 here, and I'm left holding how much with QID? I think I have 5 contracts more. Yeah, I have 5 more contracts, but because the market tend to rally today, I actually lost money on the contracts today. But as you can see, these contracts are free, and I have an expiry date of April 14 here. So my expectation is that coming into the next Federal Reserve meeting where they talk about rate hikes, you might see some volatility, you might see some downside, and I'm able to take out more profit from these. But there's a possibility that we won't see that, because as you see, but it's just 1 day still, so you don't want to judge the market over 1 day, and I'm still learning myself. So today you have everything blasting up today, going to the upside. If you want to see the broader market, you look at something like the S&P 500, and that is when you're playing the US market. You look at the S&P 500 up 1% today, but that's the big broad S&P 500, not the SPY. Up 1% today. You have the Dow up 1% today, and you have the Nasdaq up 3% today. So everything is moving up today. It might be, what do they call it, like a dead cat bounce. I'm not sure what's going to happen, but I really didn't play anything today. I just did some other stuff. I did some other work. I actually do real work, like I have plumbing job, I have a business that I'm working on and trying to build to get some cash flow outside the market. So that's what really happened today. I didn't really do any trades, I didn't do anything like that. But if you were confused as to what the pro shares are, so pro shares is basically a fund, and then funds can track certain stocks. They don't have to really be, how can I say, they can track them. So instead of you buying the exact companies, some funds tend to track the stocks and then give you exposure to them that way. How could I explain? So instead of you buying the S&P 500, there's something called the SPY, which gives you a different exposure to it. So, and you see this name here, the SPDR. So that's the Spider Fund. That's the name of the group that tracks the S&P 500. So you see the number is different, but it's similar. So it's a little off, yeah. But you see where the percentage up, it tries to match it some way. So you look at the SPDR. It's a different kind of group. See, State Street Global Advisors, Spider Funds. So that's how it's a bit different. Yeah, see, Spider is a short form name for a Standard & Poor's depository receipt. So if you look at depository receipts, they're even Chinese companies. Let's look at them, like Alibaba. They have something called what's an ADR. Let me show you. Alibaba on the US stock exchange is an ADR. So what is an ADR? Let's type it up. See, American Depository Receipt. So when you buy a Chinese stock on the US stock exchange, you get what is called an ADR. So they only give you exposure to the stocks. You technically don't own the exact Chinese stock in the company, which is kind of sketchy, but it's the reality. I mean, people have been doing this for years. You just tread lightly, you tread cautiously. But the main point of this video, I wanted to show you these things that I'm really going to be focusing on. These tickers that I see a possibility to trade them on a regular basis if we really spot some trends in the market environment. Like if you spot like a negative market sentiment, you could go for the SQQs, you could go for the QIDs. If you see a really positive sentiment, you could go for the TQQs, you could go for the QQQs. So if you look for the QQQ isn't even leveraged, but you see it's up. Let's see how much it's up today. It's up 3% today. So this can even show you the broader market sentiment. If you're looking at the QQQs, you're looking at the SPY, you're looking at the NASDAQ. So you're looking at the SPY. So the SPY is up as well. If you were to look at the Dow, the DJI, no, Dow. No, not this Dow, wrong Dow. DIA. The Dow Jones. So the Dow Jones is more of industrial stocks. So it's different kinds of stocks here, but you see it holds mainly United Health, Home Depot, Goldman Sachs, a lot more stable stocks. Microsoft, McDonald's, Visa, Salesforce, Honeywell, Caterpillar. So these are more stable stocks. But if you see all of these, what do you call them? ETFs, or there's another broad name for them. I don't know why it's slipping me right now. But if you see these up, like generally the entire market is up. I'm not sure if this will carry on to tomorrow or even next week. So I'm treading lightly, but I still make sure you own the long term, and we have exposure to both sides. But I know last week was very bloody, very terrible, and Bitcoin is still down. So let's see where we go from there. If you actually watch this video, thank you for tuning in, and I'll see you in the next one.